We will be going over the multi-step income statement in this audio refresher. The key isn't memorizing random items, it's memorizing the order of the income statement from top to bottom. Once you know the flow, every question becomes a placement question. Picture the income statement as one long staircase. We begin with net sales, then subtract cost of goods sold, including freight in, because freight in is part of inventory cost. This gives us gross profit. Next is operating expenses. These are the normal expenses required to run the business, such as selling expenses like advertising, commissions, and freight out, along with general and administrative expenses like office salaries, office rent, insurance, utilities, and depreciation and amortization, which are usually operating expenses unless they relate to a non-operating asset. Gross profit minus operating expenses equals operating income. Next come non-operating items. These are activities that are not part of the company's primary operations. Common examples include interest revenue, interest expense, dividend income, interest income from investments, realized gains and losses on investments, realized gains and losses from the sale of assets, gains and losses on extinguishment of debt, foreign currency transaction gains and losses, and remeasurement gains and losses. Remember that unusual or infrequent items also remain in continuing operations. After adding and subtracting all non-operating items, we arrive at income from continuing operations before income taxes. This is one of the biggest exam rules to remember, because income tax expense is calculated here. Taxes are calculated after continuing operations before tax, not after discontinued operations or other comprehensive income. Subtract income tax expense, and you now have income from continuing operations after tax. Next comes discontinued operations. These are always presented below continuing operations and are reported net of tax. To qualify as discontinued operations, 3 conditions must be met. First, it must be a component of the business. Second, it must represent a strategic shift. Third, it must either be disposed of or classified as held for sale. If it is classified as held for sale, remember the 5 additional requirements. Management is committed to a plan to sell. The asset is available for immediate sale in its present condition. An active program to locate a buyer has begun. The sale is probable and expected to occur within 1 year, and it is unlikely that significant changes will be made to the plan or that the plan will be withdrawn. Also remember that discontinued operations include both the operating income or loss of the discontinued component and any gain or loss on disposal. Both are reported together below continuing operations and net of tax. After discontinued operations, you arrive at net income followed by other comprehensive income, or OCI. Remember that OCI items are presented net of tax on the statement of comprehensive income. These items bypass the income statement and are reported directly in equity until they are later reclassified if applicable. The OCI items you need to know for the exam are pension or retirement adjustments, unrealized gains and losses on available for sale debt securities, foreign currency translation adjustments, and certain gains and losses on cash flow hedges and instrument-specific credit risk. One of the biggest exam traps is foreign currency. Foreign currency transaction gains and losses go to net income, while foreign currency translation adjustments go to OCI. Just one word changes the answer. Another common trap involves investments. Equity securities generally report unrealized gains and losses in net income. They do not go to OCI. In contrast, unrealized gains and losses on available for sale debt securities are reported in OCI until they are realized. Comprehensive income is simply net income plus other comprehensive income. Now let's review the entire flow one more time. Net sales minus cost of goods sold equals gross profit, minus operating expenses equals operating income, plus or minus non-operating items equals income from continuing operations before income taxes. Minus income tax expense equals income from continuing operations after tax, plus or minus discontinued operations, net of tax equals net income, plus or minus other comprehensive income, net of tax equals comprehensive income. Finally, here are the rapid-fire rules to remember for exam day. Taxes are calculated after continuing operations before tax. Discontinued operations are always presented below continuing operations and always net of tax. OCI is presented below net income and is presented net of tax. Foreign currency transaction gains and losses go to net income. Foreign currency translation adjustments go to OCI. Equity securities generally report unrealized gains and losses in net income. Available for sale debt securities report unrealized gains and losses in OCY until realized. When you feel overwhelmed during the exam, don't memorize individual items. Instead, picture your income statement staircase. Gross profit, operating income, continuing operations, before tax, continuing operations after tax, discontinued operations, net income OCI, and finally comprehensive income. If you can visualize that staircase, you'll answer the vast majority of these presentation questions correctly.